Hey guys, it's Alvin here. If you're local investors, you realize there's a lot of benefits of investing close to where you live. You also may have noticed that the investment opportunities that were there a couple years ago are no longer available. So you may have to start looking at other markets to identify the best opportunities for you. In today's video, I speak to a group of local investors at a RIA meeting, and I'm brutally honest about the realities of our local market. But there is good news. We introduced the Rent Market Scorecard, where we give the actual data investors need to make an educated decision. Because it was at a RIA meeting, the video is a little bit further out to show the crowd, but the audio and the information is excellent, so enjoy the video. Guys, my name is Alvin Taveras. I'm the founder, CEO, and broker of Build to Rent. My background is in corporate sales, worked for Colgate-Palmolive, MetLife, ADP, and most recently Gartner. I'm proud to say that I'm financially free because of real estate. A couple of years ago, my wife and I were very aggressive on doing live-in flips and paying off all of our debts. And I got to the point where 6 years ago, I kind of realized I didn't need to work anymore. So I asked my wife for her blessing if I could leave the corporate world, and she said yes. I was already doing real estate investing, so it was a natural fit to go into that. And I thought I was just gonna be an investor. So I got a broker license just for myself. And then along the way, I kept helping people out. An old lady from church wanted to sell their property. All right, I'll help you. A newlywed wanted to find an apartment. All right, I'll help you. I quickly got to the point where I hated everything to do with my license. I wanted nothing to do with it. And the main reason is I wasn't doing the things that I was most talented at. I didn't want to do open house, didn't care to, but I did want to help investors find the best deals. So I learned to say no to almost everything so I can say yes to what I'm really good at. To be really passionate about what I do best, which at the time was doing rehabs. And I started my first company, which was Cape Coral Investor Network, and we're helping a lot of out-of-state investors invest here locally. Now, the obvious question is, why don't you work with local investors? The short answer is you guys are difficult, and you guys complain a lot, and
It's true.
no, well, so and the other part of it is you guys a lot of times want to pretend like you add a lot of value to the deal. And it's not always the case. And so wait. No, well, I said that because I'm saying no to almost everything. So what I do say yes to is out-of-state investors. And so here's what happens as well, is when you look at the risk versus return of your deal, a lot of times when you get involved in it, you're actually adding more risk to the deal. You're taking on more risk. You're trying to do more than you should. And you have to compare that to an option that has no risk or has very little risk. And so most of you should be more passive. Maybe not all of you. Maybe other people who are investing in this area should be more passive. And so what I've learned is after being a rehabber for a long time is I had an investor who already bought 19 properties from me. And he said, hey, I want to get into new builds. And my immediate response was like, no, you have to add value to the deal. You have to do forced appreciation. He said, hey, I want to do one anyway. So I helped him out. Then it worked out for him, did 3. And then before you know it, about 70% of my business was all new construction. And new construction was a lot easier than a rehab. Identifying a property was super easy. I had an inventory list of 30 properties, just kept selling them. All the models were exactly the same. I can pair them up with someone like Mike Lyons to do the property management. He already has the photos for it. He already knows the rental values. He already knows everything. And we're able to provide what was more of a turnkey service. And that's when we went ahead and rebranded to Build to Rent. Now, Build to Rent is a category name spelled out Build T-O Rent. So obviously, being really big into SEO, I changed that and just put a 2 in the middle. So now whenever you search Build to Rent, we come up. So very good for lead generation. But what I've learned over the course of working with a lot of investors in buying new construction properties is that the rents are a lot higher. The maintenance are a lot cheaper. It's easier to get tenants placed because tenants prefer newer construction. Also, we can get financing incentives. So like we're talking about what you're competing against. So my investors are getting loans as cheap as 3.75% interest rates. So that's what my investors are getting. They're also getting 2 years free property management. So when you go to an out-of-state investor, so for example, we had one who was a VP in Washington. He worked for Microsoft. And he sold 1 condo and was able to buy 5 properties here in Florida. He sold for $1.3 million, bought 5 here, Now he's retired in Egypt, living off of those funds. Like one property was able to do that for him. And that's the kind of money that's coming in here. It's money that wants to be more passive, doesn't want the brain trauma, just wants to make a smart decision once and never think about it. So we had a good chance to have some banter early on about the market. I'm curious about whether you guys are pessimistic about the market we're in right now, specifically in Southwest Florida. Is anyone overly optimistic? On anything. We consult, I speak to at least 3 investors every single day, at least 1 builder every day. The general market is concerned. And when they look at this market, they're wait and see. And so what you find is that there's 3 types of investors that operate in this market. You have some that are like Jeff, who kind of see blood in the waters and they get greedy. They want to jump right in. That's one type of investor. And there's a lot out there that are like that, who are looking to negotiate even harder. There's a third kind of investor that's basically sitting on their hands, who says, hey, I don't want to put my money invested into real estate right now. I want to be hands off, pencil down. And then you have the the second type of investor, which I think I'm in that category, where I realize the benefit of real estate investing, and I have to deploy capital each and every year. So there's a lot of investors that have the cash. They need to put it to work. So on the first sheet that I have here, if you guys look at the pamphlet, I'll be able to share with you why I'm so convicted in real estate. And I know all of you guys are real estate investors, but it's times like this when you're concerned, when you're worried, and you're looking at alternatives to place your money, that you have to look at all of the options. So one of the obvious things that people say is, well, I can get better returns in the market. So here I have a very aggressive assumption of 15% in the stock market on returns that we're getting, right? This is what I would often hear when I speak to an investor, well, I can get better returns in the market. And so when you look at it, is yes, stocks give you 15% appreciation, but you only get that money when you sell. If it goes up in value, goes down in value, you didn't actually make anything until you had sold it. Then your sell determines how much you actually made. Additionally, you can't sell it monthly. You only sell it once. You have one time to sell it, and that's it. You didn't take advantage of any leverage. So 100K or 110K that you invested in the stock market only gets you 100K of assets. You're not using leverage for that, and no one's paying down your debt. So stock market, if you look at it, it's only 15% returns when you sell it. When you compare it to bonds and other savings account, which is what a lot of people are parking their money in, they're looking at this as being safer options, parking their money in bonds. But again, you only make money one way. You're missing out on the other 4 ways of receiving the benefits and the wealth creation of real estate. So why investors like myself have to continue to deploy capital regardless of the market is because I know that I can sell my property in 5 years. I can also sell it on a monthly basis. That's called rent. That's my cash flow. Additionally, one of the biggest wealth creators is a debt pay down. Someone else paying down your mortgage for you. I always jokingly say that every property you buy is 75% off. You just have to wait 30 years. That was a joke, guys. All right, cool. But it's 75% off. Any property you buy, so long as the tenant's in there paying the mortgage, is 75% off. You can't do that with any other form of investing. So for me, if I'm looking at this and I'm saying like, there's a gun to my head, every dollar I make, I have to go buy more real estate because I'm so convicted of the benefits of it. And the other part of it, especially if you're self-employed, is the tax benefits. You can technically take advantage of tax benefits in the stock market, but that's at a loss. You have to actually lose money to take advantage of any benefits. When you get into cost segregation, bonus depreciation, it's like there is no greater wealth producer than keeping more of your own funds. So a lot of times we work with investors that are in Texas, New York, California, or wherever. They're high net worth individual. When they look at their expenses, their single largest expense is taxes. And so they don't care about $400 in cash flow, but they care a lot about that 40K tax reduction they can get off of their earned income. That makes a huge difference for them. And that's why these investors, particularly ones from out of state, are continuously going to keep putting money into this market. Wanted to start off really optimistic about real estate, because now we're going to talk about some of the things that are happening here locally, and maybe that will bring us back down to earth and we'll get kind of more realistic. You're putting 110K into a deal and getting a 400K asset. So you're putting 25% down into a deal. Correct, and you can see the difference across the board is what you actually get when you close on the asset. You actually get a much more expensive asset. This was a phenomenal market for several years. And the reason why I jokingly say that you guys are difficult and don't see what's right in front of you is because if you look at the deals that were here 5 years ago, and Reed isn't here today, but Reed and I did a lot of them together. Some of these deals were properties for 210K just 5 years ago. Like this was an obviously growing market. The rents back then, when our investors were buying these properties, were 1,700. Now, Mike's gonna fight me on this, but now a lot of them are getting 2,200 in rent. So we're seeing huge appreciation on the rents, and interest rate at that time period was 3.3%, compared to now, which is 7.3%. So at that time period, everyone in this room thought this was a bad deal at that time. Now we look back 5 years and it's a phenomenal deal. All of you would jump at that deal right now if you could. And so the same is gonna happen when you fast forward 5 years. It's always easy to be pessimistic of today's news. There's always a negative headline. A couple years ago, I had an investor ask me how the war in Ukraine was affecting property values here. I was like, because that was topical at that time. Now this news cycle changes and we move on from it. So a lot of the good news we're gonna see of today's market, we're only gonna realize it 5 years from now. We're not gonna see it now. Now we're just gonna see this pessimism that exists here. So when we look at some of the pessimism and what's currently happening in today's market, like we talked about, rents are down across the board, prices are down across the board. Actually, we have 2 consecutive years of Lee County prices being down, slightly, but still. And no one's forecasting that we're gonna be at 4% appreciation in this market. Mike, correct me if I'm wrong, but you're not anticipating rents shooting up either. So if you're looking at this market, you're kind of saying like, hey, I believe long-term in this market. The short-term victories are not going to be there. In fact, benefits are mute at best, they might go down, and your costs are also going up. When you look at insurance going up, it's up 43% over the last, since 2018. So insurance is shooting up, and then we have also a lot of our other costs going up as well. So homeownership is going up while all of the benefits of real estate are actually being stagnant. So the big question is, all right, what do you do? So we're in a market that you could decide to tough it out. You could decide to change something up. And what we're saying is people are coming in looking at what they're gonna do next. So currently we have a lot of builders who are still acquiring land here, and they're still very optimistic. And a lot of them are established, have heavy funds. We also have a lot that are very light on funds. And I don't know if you guys know this, but 10% of current properties are actually considered abandoned at the moment. We had a huge surge in permits in 2021, and since then, 10% of them have been abandoned.
So is it 10% of the new construction, is that what you're referring to?
Yes, correct, yeah. Abandoned, stalled, whatever. Yeah. And so I think we all know of a couple different builders that went belly up recently. Obviously, BD Development, Delta, Blackfin are 3 of the big ones. And so what they all had in common, and not to say anything bad about them particularly, but there was a time period where getting contracts was super easy. And they kept thinking that I'll keep getting more contracts, getting more people's deposits, and eventually we'll hire the right people. Eventually the city will work its stuff out, we'll get through the permits, and it just didn't happen. So what happened with a lot of them, some of them were blatantly lying. So some of them were taking photographs of other properties claiming it was the builders. Some of them were also sending those photos to the lender. So there is one builder, I'm not gonna say them directly, but they were getting 70% of the build up front before doing anything. And I get a lot of these phone calls from investors that are stuck. They're from out of state, they have no idea what's happening with their property, and they reach out to us trying to figure out what they can do about it. So one investor had spent $220K on a property that's 25% done. And when asked how much it's gonna cost to finish it, the answer was $180K. So if you're an investor in that position who saw the looked good, talked to the salesperson that looked good, everything checked out, but you're in a position where like you're gonna lose for sure either way. And do you go through with the build? Do you just sell it for a crazy loss? And that's happening across the board with our investors, which is typically why I don't recommend doing ground up construction. Specifically not in this market. Mind you, I preference that with there's people who have enough experience or people who are willing to pay that dump tax to make it work. But most investors aren't looking to do that. So when you started out, what was the loan terms that you would receive in your first build? Yeah. 12% construction loan, yeah. What's happening right now in the lending space for ground up construction is a lot of lenders are asking for at least 5 builds in the last 2 years. Most investors can't do that. So now they're having to do hard money loans that are at 12, 14%, which you could potentially pencil out if you're building a property in 6 months. But realistically, a lot of the builds are taking now a year and a half to be completed. So that's a huge cost. We're not at the point now where we're having huge escalation clauses being kicked in where the prices are being accelerated. But at the moment where our appreciation isn't predicted to go up, like you're basically taking a gamble. The only reason to do ground up construction is because you think you're going to have day one equity once you close on it. Like now that you can no longer predict that and the risks are more against you, it makes no sense to do it if you're a newer investor. You're way better off buying a property, even negotiating on price on a property that's already completed. So builds are selling for close to cost right now anyway. Like there are a lot of builders who can't compete with the D.R. Horton. Who's from D.R. Horton? Leonard. Who was it? Yeah. Do you do the spot lots or do you do the communities? You do both, yeah. So there are a lot of builders who can't compete with a Lennar. They can't do the scale, they don't have the financing, they don't have the terms. Most investors are using their own funds for these builds. I mean, most builders are using their own funds. Lennar, D.R. Horton, all those guys, they're using their investors' funds. Their math is different than most builders. So to compete with them is very difficult. So what they were doing is they were competing on the move-up market, or a little bit nicer end, a little bit more semi-custom was the room that they were competing in. They can't compete with the cheapest in the market, but they could compete with something a little bit higher end, nicer baths, nicer showers, etc. Now that market's eroded. That secondary markets of people moving up and getting a nicer home for themselves, that market's gone. So the only thing that's really sitting there is that market where people are looking for more entry level, more affordable homes, and maybe 10 years down the road, they'll move up. So those builders that were building properties for that move up buyers, they're now forcing to go more aggressive on prices. And so I represent a lot of those builders and we sell them directly to investors as far as a package deal, et cetera. But they're being forced to like try to compete with price with the Lennars and D.R. Hortons, and they can't do it. So they're scrambling. Generally, when we would field these calls, I would always try to avoid it. But then we kept getting more and more of these calls. So we started figuring out how do we get proactive and help investors who were stuck in this situation. So if the build never got started and it was just a permitted lot, typically what we would do is we'll trade in those lots at value for a brand new construction. So like we're working with somebody now who has 2 new builds in Port Charlotte. Combined, they're worth about $50K. And so we're trading in that $50K into a down payment on an already finished home. So the builder wants to get rid of their completed homes. And they'll mind buying land if it means they can trade it for a completed property if they don't want to hold anymore. And that's a win-win for that investor as well, who can now get out of just having land and having to wait a year and a half to build on it.
So you broker that?
Yeah, correct. Yeah, so we do that. So now if the property's already semi-completed, those are tricky. And the reason why they're difficult is, and so this is what's happening with Blacktip, is they're being sued by their contractors, their roofers, the guys who they owe money to. And they're supposedly have accounts receivable saying they're going to get paid by the lender. So they can't release that contract, then it gets rid of all of their accounts receivables. It means that money is no longer due to them. So they're stuck holding on to these contracts. They're not releasing their investors from those builds as a result of it. So those are difficult. And I try not to get involved in those things, but the obvious answer is to go see a lawyer, right? And for how to navigate it. Either way, it sucks. And it's something that, if you're newer to the game, that's an unnecessary risk that most people just don't have to take. And so what happens as well, sometimes they'll lay the tiles in with no windows, and it'll be like that for 6 or 8 months at a time, just sitting there. And somebody will buy them saying, all right, the floor's done, great. But there's water been building up underneath that for a while. So there's you go on Cape Coral, there's a lot of these builds just sitting there. And a lot of times these investors are calling the builders saying, hey, like, what's the update? And they're like, oh, yeah, we're waiting on the city for whatever. And it's like, nothing's happening. Like, a lot of them are just sitting there. So that happens a lot where money is released for a certain portion of the build. And some portion of the build gets done, but the next portion doesn't get released until a certain part's completed. That part never gets completed. It's just like it's a standstill. It's a debt. And so you couldn't go after if they have a bond on the property, which is what you're referring to on the insurance bond. You can try to get funds that way, but otherwise it's super difficult. So what I did for just you guys who maybe are in Southwest Florida and want to look at other markets, I did what's called a build to rent market scorecard, which is the sheet there in the back. You'll see the numbers there. And so what I did is I was able to pull a lot of the county data from across the state of Florida. I can do the same for multiple other states, but I focus just on Florida. And it's a way to kind of gauge, depending on what your strategy is and what the market's presenting you, is what you can look to play. So again, you have all the raw data there. I pulled some of my notes there on the side. And so, when we look at a market like Broward County, which is on the first page, so one of the things you want to look at is you want to look at the cost. So the way the map works, you look at the cost per acres, and generally for rough numbers, you can put 4 units on an acre for rough numbers. And so that gives us a cost per unit for the land cost itself. Generally speaking, again, rough math, your build cost is going to be about the same, so you want to focus on the land cost itself. And so when you look at a city like Broward, you look at, okay, pretty good income, decent growth, high income change, but then you look at the cost per unit, and it's super high. It's $200K per unit just for the land. So the only way to make a market like that work, and I have people calling me saying, hey, what about in Broward? What about Miami? It's like, the only thing that works there is a 100-unit condo building, where on that same 4 acres, you're putting 100 units on it. It doesn't work for putting 2 units in because your land cost alone is $500,000. It doesn't work. So you want to look at markets that have obviously a much lower cost, and you want to look at the rent to basically oversee that. So we look at the city just below that, Charlotte County. You see huge population growth at 9.2% over the last 3 years. We see a decent income at $55K per capita, a pretty decent income increase, but then you go to the vacancy rate, which is at 12%, and that's pretty high. So a market like that looks exciting on a number of things. A lot of things look good. Even the cost for land is very low. But then you get to the vacancy rate at 12.1%. That's high. That's going to be a wet blanket on your rents, and that's going to suppress it. So again, a market like Charlotte is okay to invest in if you're very long. If you feel like this is going to work itself out and you're going to be okay to hold on, that will work out. But there is definitely downward pressures on your rents. If you look at the next page, we look at Hernando County. So Hernando County, for me, metrics-wise, is one of the best markets just on paper, just high level. So Hernando County is just above Tampa and just south of like the Inverness, Citrus Springs, that area. So it's a coastal area. They have okay earnings, okay growth, but their cost for lot compared to the rent is super favorable. So the rents are actually very high compared to how low the cost of the land is to build on. So that's a phenomenal market. Now what you're going to get there is you're not going to get much appreciation. It's basically a flat market, but you're going to get really high rents given the cost. So you guys have a copy of all of these to review on your own. If you need a physical copy of this, you can email me directly. You have my business card and everything there. In case you guys are curious to see what I did, so one of my favorite markets is Marion County. And so in Marion County, we're able to have duplexes for $400K, where each side's renting over $1,400 a side. And so we're able to do, again, 3.75% interest rates in that market and 2 years free property management. When you look at the numbers compared to anything else, and again, we're talking about the risk given the work you have to put into it, super low risk and very high payoff for a property like that. And Marion County is exploding. So Amazon has a big facility there, FedEx has a big facility there, Publix. It's growing tremendously, and numbers are just phenomenal across the board. So you guys have these sheets, they're yours to keep. I kept the raw numbers for there. If you want the actual raw data, I can send you a file as well, so you can look at that as well, and I can walk you through the database of how I have. One of the biggest mistakes developers are doing right now is they're all chasing this A-class property. They're all chasing these really high rents, and they might get it, but then when they don't, they're screwed. So you want to chase what's affordable to most people, and that's really rents between $12,000 to maybe $12,000 to $1,600 is really that sweet spot where that's affordable to most people. And so you can do that by either going higher in units or going to areas where it's much more affordable. So in an area like Ocala, for example, you don't have to put a garage in. That market doesn't expect a garage. 2 bedrooms is good enough for them. They don't need 3 bedrooms. They don't need high-end. So your cost to build in that market, given the rent you'll receive, is much more favorable. So again, if you are pessimistic like I am, and you think that there is going to be downward pressure, you want to be a market that's already affordable to most people. And so if you think about a recession taking place and people losing their job, they're all going to go down a notch. They're all going to chase more affordable housing. And so if you're already offering affordable housing, you're going to get greater demand for your properties. So for example, in Marion County, much more price sensitive, right? And they're much more functional. They're going to go on Zillow and say, I need 2 bedrooms, 2 baths, that's it. That's why garages are not important in that market. In a market, if you're going to be like in Rotunda West, near the beach and a little bit higher end, that's more of a lifestyle market where people are going to want to buy and have more space and maybe pay a premium for those things. Generally speaking, 2 bedrooms hit that sweet spot, but you want to look at your cost to get to that bedroom. Now, if it's a single family home, the cost to build a 4-bedroom and a 3-bedroom for the same square footage is about the same. So you're almost better off putting in a 4-bedroom somewhere. And what some builders do is when they apply on the septic permits, they'll put it as a 3-bedroom, but they'll put an office space with a closet and a window, so that functionally, that's a 4th bedroom, even though their permits say it's a 3-bedroom. Cool, thank you. I'll stick around if you guys have any more questions, and see you all next time. Hey guys, thanks for watching the entire video. Now I want to hear from you. I will be replying to each and every comment. Also, make sure to like and subscribe. If you want to get more information or want to schedule an investor consultation, please go to buildtorrent.com. I'll see you all there.